Good afternoon, ladies and gentlemen. I hope you are all doing well. My name is Joseph from 100 Conferences. For people who are not familiar with us, we are a European private equity and a venture capital platform, already more than 5 years on the market, connecting private equity professionals. For more information, you can just visit our website, 100conferences.com. I would like to welcome you all at our second session from our webinar series, today with the topic Strategies of LPs Going Forward. I have just one technical information for you. If you have any trouble connecting, we recommend to use the Chrome browser. I would like to encourage you all to use chat, questions, polls in the right side of your window to get interactive with all the speakers. In the email, which you will receive after the webinar ends, you will all receive the presentation from Preqin, which will be presented from Justin at the start of the webinar. And you can already save the date for the upcoming webinar on 18th of June, which will be on the topic of venture capital and the impact on COVID on it. And we are working also on our virtual CE conference, which will take place on 25th of June. You can always find more information on our website. I would like to thank the partners of the webinar, the main partner, the Silverfern Group, our media partners, Preqin, IPE, ILPA, and CE Legal Matters, and all other partners and associations. We at 100 Conferences have known Silverfern for many years as a contributor and a sponsor, as an opportunistic investor across its entire 20-year history. Silverfern was prepared to invest very cautiously, or even not at all, in periods where valuations seemed artificially high and debt was almost free, and to invest conservatively in times when the market corrected. Silverfern was a very active investor in 2009 and 2010 when it opportunistically took advantage to drive value creations for its investors. Silverfern just announced a successful first close of its latest fund that will specifically target opportunities created by the COVID-19 correction. Robert, who is running Silverfern's Frankfurt office, is responsible for Silverfern's investor relations. Robert, please take it from here and you can introduce the panel.
Thank you very much, Joseph. And it's always a pleasure being here. And it's great to see that we cracked the 3-digit number. So, and yes, as Joseph said, please be interactive, go onto the chat and the polls so that we get food for thought and can pick up your questions and thoughts in our discussion. And make it as valuable as possible for you as an audience. And now it's my pleasure to introduce a panel to you. Ladies first, Margarita from PFR Ventures, an experienced investor and business angel since 2016, director of the PFR Ventures. And prior to that, she was a founder and managing partner of INEA Innovation Capital. And prior to that, she had various operational and general management roles and positions as CEO of large companies and the United Nations. Next to Margareta, from Stepstone, Akilian, Senior Associate for European Private Equity Investments, Primaries, Secondaries and co-investments, been with Stepstone for 5 years, covering the whole pan-European landscape and contributed over 40 commitments on the Stepstone platform. From the European Investment Fund known as IFE, Marco, he has a 20-year experience of more than 20 years in the marketplace, being more than 10 years with the IFE, head of division at the European Investment Fund, in the LP role, been a GP role prior at Innogest VC Fund, and been prior to that at Ernst & Young, we all know, for their accounting, audit, and advisory services. But before we get into the discussion, it has always been a good starting point to get some of the latest data, and for that we welcome our Justin from Preqin, our data partner. And Preqin, I think, needs no introduction, is one of the leading data platforms for alternatives, and Justin is a VP for Fund of Fund and Preqin's investor Institutional Investor Research Group. So please, Justin, kick it off and put some of your latest data here on the screen. So please take us through what Preqin is finding out in these unprecedented times.
Sure. Thank you very much for the introduction, and good afternoon, everybody. I hope that you all and your families are keeping well during these difficult times. I am, however, happy to be here today on this webinar to share some insights on the strategies of LPs going forwards and the impact of COVID-19. So today I'll be taking a bird's eye view of the market, where we really see three key themes. So the continuing growth of alternatives, strong investor sentiment for the sector over the longer term, but also the conditions, for a period of retrenchment during this crisis. And I'd also like to pose you some questions. Will momentum 2020, and how will alternatives investors respond to the challenges ahead? So I'll be exploring some of the data behind these themes today, and sharing our latest investor survey on the impact of COVID-19 for investors. So what do we see coming into 2020? Well, there are now more than 12,000 institutional investors active in alternatives. Private equity remains the most popular asset class, with 66% of investors maintaining an allocation, followed by real estate and hedge funds at 60 and 46% respectively. This increased demand, with more institutional investors active in alternatives than ever before, is reflected in the more than threefold increase in alternatives AUM, which reached a record high at $10.3 trillion in June 2019, the latest data available. We expect this to continue to increase by almost $1 trillion a year, even considering a potential slowdown as a result of the COVID-19 pandemic. So, why do investors invest in alternative? What are their motivations? Well, here we can see that while investors invest in alternative assets for a variety of reasons, diversification is key across all asset classes. The diversification benefits of investing in alternatives, particularly during a challenging period for equities and fixed income alike, are likely to continue to be highly valued by institutional investors. It's also clear that investors target higher returns for private capital, particularly private equity, and that these funds have largely delivered, with Preqin's performance data showing that across most of the private capital industry, funds of vintages 2010 to 2016 have delivered median net IRRs of around the mid-teens. So, how did investors feel about this performance in 2019? Well, we interviewed institutional investors in November 2019 and found that across all private capital, a majority of investors felt that the performance of their investment portfolios over the last 12 months had met their expectations, with real estate, private equity, and infrastructure investors particularly satisfied, around a fifth of each stating that performance had exceeded their expectations. For hedge funds, although performance was recovering, this was not enough to satisfy all investors, with 40% stating performance had fallen short of expectations, though a majority still felt their expectations were met or exceeded. We can also see that most investors remained confident at the end of 2019 that despite rising asset prices and an uncertain economic outlook, that their portfolios would continue to perform throughout 2020, with more than three-quarters of investors across all asset classes stating they expected their portfolios to perform about the same or better before the impact of COVID-19. So, in light of their views on performance, what were investors planning for their commitments this year? Well, here we can see the continuing strength of investor demand across alternatives, with a majority of investors across all asset classes expecting to commit the same amount or more capital over the next 12 months compared with the previous year. Similarly, investors also intended to invest more capital in alternatives over the longer term. This is particularly apparent for private equity, where 51% of investors stated they would invest more capital, in addition to the 44% who would invest the same amount. Less than 10% of investors across private capital intended to invest less capital over the long term. This sentiment for alternatives bodes well for the industry and indicates that while fundraising may be challenging for the latter half of 2020, funds launched following this should see strong investor demand as well as opportunities arising from the crisis. And on a final note, as we moved into 2020, it was also clear that investors had increased their focus on ESG. Around a third of investors across alternatives already had a policy in place, with 14% of private equity investors stating that they would introduce a policy this year. Although the pace of developments may change here as a result of the pressures caused by COVID-19, with 61% of investors stating that ESG will become more integral in alternative assets, in addition to the 10% who felt these factors were already integral, ESG is here to stay. So, how have these results been impacted by COVID-19? Well, at least for the short term, investors are revising their commitments to alternatives following the market disruption caused by the pandemic. And in this section, I'll be sharing the results of Preqin's April 2020 investor survey and discussing how investors view the impact of the current situation on their operations, allocations, and future strategies. So, how have investors' operations been impacted? Well, we can see that the way investors approach certain practices may be changed by the pandemic. When asked whether travel restrictions and social distancing measures were affecting their ability to make new investments at this time, 82% said that these factors were having an impact, as face-to-face meetings are either fairly important or even essential to decision-making. Will investors be able to embrace remote working as the new normal? Well, while 1/3 of respondents said that fund manager marketing documents and pitches make face-to-face meetings non-essential, over 50% stated that these documents and pitches do not mostly or ever replace the need for face-to-face meetings. And what are investors' views on liquidity and the denominator effect? Well, here we can see that just over a quarter of respondents are concerned about liquidity and the ability to finance capital calls in 2020. Food for thought for fund managers over the next few months. Perhaps more concerning is the proportion of investors stating that the impact of the denominator effect on their alternatives portfolio is a concern. 46% stated this in light of the fall in the value of public markets. With some target allocations now out of line, investors may look to reduce commitments to new funds and to utilize the secondaries market as the impact of this crisis takes hold. And the scaling back of new commitments is shown here. When we surveyed investors back at the end of 2019, the majority, or 83%, said that they were planning new commitments to alternatives in the year ahead. Fast forward to April 2020, and 59% of surveyed investors now say that the number of commitments they plan to make to alternatives in 2020 has slightly or significantly decreased, with only 9% of investors planning to increase the number of commitments. And amid fears of a sharp global economic downturn, investors are also reducing the amount of capital they intend to commit to alternatives. 60% of those surveyed plan to decrease the size of their planned commitments either slightly or significantly. It is, however, notable that 472 fund searches and mandates were issued across alternatives since the beginning of April 2020. So we can see that the economic impact of the COVID-19 crisis has hit some industries more severely than others. As retailers across the globe face a dramatic decline in footfall due to government lockdown measures, it's no surprise that 34% of surveyed investors said they plan to avoid retail-focused real estate investments in 2020. Conventional energy-focused natural resources and retail-focused private equity were also highlighted as sectors to avoid. And although almost half of investors said that they were not avoiding any particular regions or sectors due to the crisis, it's clear that retail-focused strategies will continue to suffer. On the other hand, investors appear to be looking closely at healthcare-focused private equity for the rest of the year. With healthcare systems across the globe challenged by the pandemic, it is possible that governments will look to stimulate private investment in healthcare. With characteristics including non-cyclical demand and the potential for a steady income stream, 36% of surveyed investors plan to target the sector in 2020 as a result of the pandemic. Investors are, perhaps unsurprisingly considering the potential for opportunities, also planning to target distressed debt during 2020 as a result of the impact of COVID-19. And the logistics sector, the importance of which has been highlighted during the crisis, is also favoured by investors, with 15% stating that they would target this sector as a result of the crisis. And the results of Preqin's April investor survey also correspond with the picture for fund searches and mandates issued since the start of April for private equity. As we can see, the regions targeted by private equity investors as of Q2 2020 are broadly in line with that seen for Q1 of this year and also Q1 of 2019. Although the proportion of investors targeting Europe has declined to 44% from 57% at the start of 2019, with North America regaining the top spot for the most commonly targeted region as of Q2 2020. And buyout remains private equity investors' preferred fund type, though the proportion of investors targeting this strategy has declined from 3/4 to just 59%. And perhaps unsurprisingly, the proportion of investors targeting growth funds over the next 12 months is down to 43%, down from 52%, at the start of 2019. So, what long-term impact do investors believe the COVID-19 crisis will have on their alternatives portfolio returns? Well, here we can see that many investors are concerned by the potential effects of the virus. 53% believe the impact will be moderately negative, with a further 6% stating that they expect this to be extremely negative. However, the good news is that we can see that just 9% of investors surveyed stated that they would invest less in alternatives as a result of the long-term impact of COVID-19, with 63% stating that there would be no change and 29% stating that they would invest more as a result. So, what are the key takeaways? Well, alternatives have seen extremely strong growth, and despite headwinds at the start of 2020, investor sentiment remained robust following strong performance across private capital in the short, medium, and long term, and most investors were planning new commitments over the next year. While we do expect to see a short-term slowdown in fundraising, deal, and exit activity as a result of the crisis, investors are thinking long-term and are continuing to invest in alternative assets. And despite the major short-term impact, most investors believe the crisis will not adversely affect their medium to long-term plans, and the industry as a whole appears well placed to ride out some of the challenges posed during the rest of 2020. Thank you very much for your time.
Thank you. And this is, and I hope the audience saw this presentation is available for download and will be shared following this webinar, or you could download it while Justin was speaking. There was a pop-up giving you a download link. So Preqin, thank you, or Justin, thank you for Preqin sharing this information. And we will come back to a couple of slides and talking points, and we will also try to bring in Justin on a couple of topics with further through the discussion. So during the preparation of this call, we thought, how can we structure the discussion? So we will start with a little analysis of where we are today, what happened the last 8 to 12 weeks, what were threats, difficult situations, challenges for LPs, what were the lessons learned, best practices out of that, what were opportunities and chances, how did dynamics change between LPs and GPs, and then we will spend most of the time looking at the, let's say, medium-term effects and strategies that the LPs here on the panel will apply to navigate those uncertainties. I think it's a little bit early to really give a long-term view, but we will try to give at least some outlook, some feedback, some first thoughts from our panel. So let's start with the first question to dive in. What were challenges when the whole COVID thing hit, and from a LP side, what were things that were really critical that you had to navigate? And ladies first, Margarita, what were you seeing on the venture capital, on your fund of funds side? What were challenges you were facing? when this whole pandemic started?
Well, first of all, I think that there is a general liquidity potential issues, both on portfolio companies side and also corporate LPs, especially those whose profits were coming from industry and production. So the need is, as we spoke, for some bridge liquidity for startups and so liquidity issues in general. As I said, on the LP side, corporate, especially LP side, we do not see any slowdown or any hesitance from individual investors, which we have quite a few in our portfolio. Mostly there is a slowdown, not freezing, but slowdown and some suspensions from institutional corporate LPs.
Thank you for sharing. What were situations ZIF was facing? Portfolio, you are exposed to a lot of funds. What were situations where you as an LP had to act very fast, where immediate action needed to be taken? How did that work with ZIF? Was there a good experience in the relationship with the GPs, or what did you see in your large portfolio, Marco?
Yeah, hello, good afternoon, everybody. I hope you can hear me well, as I had a few connection problems. So yeah, we have seen in the past months, of course, a number of emergencies arising into our portfolio. I would say there have been two types of situations most commonly present. One less severe but more usual, which is typically fund managers having to quickly come to decisions to extend, for example, their investment periods because of the investments lined up for analysis being delayed due to the crisis, of course, or to increase, for example, concentration limits due to the fact that they have to support further the portfolio companies. This has been very common. Less common but more severe have been situations whereby fund managers were in need of resources to support their portfolio to cover liquidity gaps, and the fund did not have enough resources to react quickly. So we have seen a number of discussions taking place among LPs to overcome these situations and possibly to provide the funds with enough money in order to cope with these liquidity issues. So, for example, we have seen funds considering solutions like preferred equity.
Okay, so we have a technical problem here, so hope that Marco will return. Okay, Stepstone, maybe you can jump in here. What did you see, and how did Stepstone had to change its interaction, and what are also key learnings from that, and things you think that will help you in the future? So.
Yeah, absolutely. I mean, I think we've been fairly sort of LP standpoint. I think very few of us of underlying LPs, our clients have had sort of liquidity issues, if any at all. I think most of the sort of liquidity issues have been on the sort of GP side, but I think the GPs that we've worked with have generally taken a very sort of thorough approach at the sort of portfolio company level. They've drawn on their RCFs, ensure the companies have been in a sort of good position in terms of sort of cash to sort of, carry on going for at least the next sort of 3 to 6 months. And generally, I think a lot of the GPs that we've had relationships with benefit from credit facilities as well. So we haven't been put under any pressure or very little pressure from a sort of capital call perspective. I think in terms of how we've had to operate, obviously, lockdown and communicating virtually has I wouldn't say it's sort of been a hindrance for the majority of the GPs. I mean, we have a lot of sort of existing positions, and many of the commitments that we've made earlier this year have been to existing GPs that we know well. So we've been able to sort of carry on that dialogue virtually. I would say it's been slightly more difficult with sort of newer fund propositions or for example, first-time funds or funds that we're meeting for the first time. That's been difficult. I think we're in a position, I think like many LPs, where we'd prefer to sort of, meet in person. So I think there've been some different dynamics at play there.
Thank you very much. And the point Marco was throwing up, did you experience a situation where you had to adjust concentration limits or other things that were put into the PPM and suddenly had to be changed because there was some kind of an emergency? And would StepStone have that flexibility, and do you give your GPs that flexibility?
Yeah, absolutely. I think it's very much sort of case-by-case basis. I mean, I can think of, without sort of, mentioning any names, I can think of two specific examples that I've been involved in over the last few weeks, where one GP had to change a sort of geographic limit to essentially draw capital to support an investment in a certain geography. I think there've been a few sort of similar cases. I think we've been prepared to be flexible in this regard. I think it is very much sort of case by case, but for sure we've had those situations as well.
Okay, so taking the short period of notice and the immediate action, we can say that LPs are today much more educated, much more prepared to really provide quick fixes for these type of special situations. Great, thanks for sharing that. On the upside, what were chances? Did you as an LP see any immediate opportunities to pick up positions on the secondary market or to somehow deploy capital in situations that would otherwise not have been appearing?
Is that still a question for me?
Marco is not there, so I stay with you, and then Margarita, and then we will wait for him to reconnect.
Yeah, no problem at all. I mean, I think it's very difficult. I think in this market, I mean, if you could sort of split our role into sort of primaries, secondaries, and co-investments. I mean, the primary pipeline in terms of sort of fund investments, we sort of know about, with a 18-month forward pipeline. I think we knew what we were going to be working on in 2020 back in 2019. So I don't think that's really changed to a large degree. I think certain fundraisers have been pushed back, and I'm sure we'll talk about that sort of later on this panel. But the primary pipeline was sort of relatively stable. I think on the co-investment side, for sure, I mean, most GPs have been clearly focusing a lot more on their existing portfolios and spending less time on new investments. I think that's had an co-investment deal flow. Having said that, there have been sort of distressed opportunities that we've seen. There have been complex opportunities at very low prices that we have also seen, specifically in businesses that are unaffected by COVID. I'm thinking of data centers. I mean, I'm thinking of maybe more so on the sort of healthcare and tech space. So I think we've benefited from looking at some pretty attractive deal flow at low multiples on a co-investment basis. On the secondary side, and I mean, I noticed a few questions come in from some of the guests on this panel. I mean, I think clearly we're going to see some pretty steep valuation drops in Q1 and possibly in Q2. In terms of pricing, that's a difficult market. It really sort of depends on the manager. We've seen a few opportunities whereby we know the GPs very well, and we're prepared to price without maybe 100% information on where Q2 valuations will be. But it's certainly a difficult market, but one we're trying to capitalize on.
Marco, good to see you back. So okay, answer the question. So, but we will get your view. Maybe on the next topic, what were best practices where you think where things changed or were rethought over the last couple of weeks, and what do you think will maybe stay here in the GP LP relationship, or generally in the way you as an LP work?
Yes, indeed. Apologies for the connection issues. As I was mentioning, there has been a good thing, which is the reactivity of the various parties in all these discussions. So, for example, transparency in communication, I believe, has increased, has benefited. also from the fact that all the in-person meetings have been substituted, replaced by video calls. This can happen very frequently at very short notice. Discussions about solutions to be adopted to face the imminent issues can be made easier. And also typical updates which can be provided by the GPs over the portfolio can have a frequency which is much higher than what it used to be in the past, and more proactive. I would say we expect that this level of increased interaction with GPs will remain in the future. I suppose that, for example, instead of traveling twice per year to visit a fund, we will likely have much more many video calls during the year, and maybe we will limit the travels only once per year. But let's say the monitoring of the investment should overall benefit. Then, of course, we have learned to run investment activity also from a distance, although not 100% of the activity can be replaced through video, but at least we have been able to move on in our processes without making funds delayed by this inability to travel. So we expect that also this may somehow have a long-term impact on the way we will conduct our business in the future. There are things, however, that will still require some form of in-person visits, and therefore this is likely to let's say not be eliminated completely.
Thank you. Margarita, in the preparation, you were bringing up an interesting aspect about also the knowledge sharing and the spirit, and also how you were interacted and knowledge was shared to get around a difficult situation. Maybe you can share that with the audience, and I think that was very insightful.
Building on what Marco said, we actually are a much younger institution. We started to operate in 2017, so we do not have that big portfolio. We have 40 venture capital funds, so it's not 400 or 500. So the direct communication we have established from the beginning, so we haven't seen any differences between before COVID and during COVID, actually. What we do, apart from some help support in terms of linking GPs or helping them in communication with LPs, we are also sharing the knowledge about how to access public funding. So this is what we do as a group, as a Polish Development Fund. We started in March the financing for preference financing, aid financing for SMB, micro and small medium market, and until now we actually deployed 10 billion Polish zlotych, and now we are just yesterday or 2 days ago we got notification from European Commission to start the state public funding and support lending with references for large corporations. So it might be helpful also for our LPs which are present in our portfolio, in corporate venture capital and in venture capital funds.
Thanks for sharing, and I think it's, as we discussed in our preparation, and what we want to share with the group is really some good has come out of it, and I think as the panelists just described, the interaction between GPs and LPs became much more interactive, much more on a short notice. People got much more quickly on the phone, on a video call, and so I think the general experience that I took out of it is that LPs felt that there was a good response from GPs, and I in my capacity see the very same thing. It's about communication, even so we don't have the 100% facts available at each and every point in time, but to keep everybody up to speed and to make sure that everybody is aware of what's happening. That really seemed to be a great outcome. But I also miss physical meetings. I have to say that. So just untechnical comment here. Miss this thing. Okay. When we discussed, you brought up an interesting point, which is maybe more beyond the strategy point. But you said there was also your experience, a shift in the dynamics between GPs and LPs that prior in 2018-19, coming into 20. GPs were pushing very hard, and then obviously now a situation came where GPs had to ask LPs, and we said there was notably a change in the dynamic between LPs, GPs. Maybe you can share some of that here with the wider audience.
Yeah, no, happy to elaborate on that, but I think it's a point that I think many LPs share. But I mean, just over the last few years, I think we've seen, quite frankly, a frothy fundraising market, which GPs have benefited from. Not just in terms of increasing in fund size, but also I think more favorable terms on the GP side for a number of those funds as well. And I think in the last few weeks, we've seen a few managers who, were in market or remain in market, maybe expecting a one and done sort of first and final close at their hard cap, have to extend their fundraise. And I do think there has been a sort of shift in dynamic towards LPs who I think have a lot more power in the current environment. Whether that continues, we'll see. But I think for those GPs currently in market, I think certainly some, I presume a lot of LPs have benefited from a sort of negotiation of terms point of view.
Thank you. Maybe Justin, to bring you in, and I also followed some of the chat conversations and the question sections. There came up a couple of questions on the fundraising side, and maybe going back to what you said in your presentation. I'm looking here at page 13, and with the denominator effect and the changes in the planned increases and decreases of commitments. And thank you for throwing that up, Joseph. You're doing the magic. I'm looking at slide 13. Now let's maybe make it more interactive. Asking to the IF, how many GPs that are early in the fundraising process or are smaller GPs come to the IF? How would you comment? Is the IF thinking about reducing new commitments? What's your view? And maybe you can start here, and then Justin can comment some of the background of the data. But I think the IF has a good view here on that.
Yes, thank you. I would say the AF tries to be as much as possible a continuing investor. I would say that during the past crisis, we have tried to act really counter-cyclically. During the 2009-2010 crisis, we stepped up with substantial amounts of commitments, taking a larger stake in funds in order to allow them reach a first closing more promptly. So the plan here for this crisis is nothing different. I would say we are expecting to be able, through a number of instruments which are being put in place, we're expecting to be able to continue providing strong support to the GPs in their fundraising, taking a number of initiatives also with the European Commission, the member states, the European yesterday approved, the board of the bank group approved which is an initiative a few weeks ago is expected to mobilize a billion for SMEs, out of which a portion of this would be mobilized through equity investment. GPs continue. Track.
Marco,
Yeah,
I think we have a connection problem here. Could you turn off the video that we have sound? Yeah. Maybe.
yeah, I cannot mute him.
Okay, Marco, we unfortunately
Also,
okay.
for easily.
Okay, we have a technical problem here, Marco.
Continue.
Maybe, okay.
The
Okay.
report. We will
Joseph. Okay. Yeah, sorry for that, but I think the general notion is that the IVE has programs and puts programs in place to support smaller GPs or smaller funds. And Margareta, how's the PFR also with your mandate picking up on that situation that maybe VCs you're focusing and in the region, if investment appetite is slower, will you pick up your investment speed to support the local Polish VC community? What are your plans?
Well, we, as IF, will be acting as we were acting now, as we are acting now. So we do not, on our side, perceive any slowdown. We are in the process of closing few funds by August. So we are in a deep negotiations at the moment, and it would be quite. There will be quite a large VC funds, of course, for our market. For our market, 15 million euros is a large VC fund. So just to give you a picture. So we are continuing our financing. As you know, we are managing EU funds. So we will be probably opening new perspective in 2021. And what we are doing, we are trying to connect and to reach to international LPs to attract them to come to Poland. We have already 10 funds among of 37, which are either there is either international investor or GP from outside of Poland. So this is what we are focusing on. We are underlining that we will not have any slowdown, any liquidity problem from our side, and we are also trying to help, as I said before, the startup companies through GPs and showing them different possibilities to access public state. But we do not see any problems in a short midterm from our perspective.
And thank you for that. And okay, and Justin, I don't know, but I think you said it. There is a gravity towards larger platforms. It was on your summary slide 21. And maybe you can comment a little bit on that, because what we see here is that the IVE and a Polish institution, that some catalytic LPs, as it was said on the podcast, that have a specific mandate, put capital behind the smaller managers, but the large pension industry and the large allocators, are they tending more to a biggest beautiful strategy?
Yeah, I would suggest that that's certainly been an increasing trend of 2018, 2019, and also the start of this year as well. I mean, to provide an example for infrastructure, by and large, the quarterly fundraising figures would appear to be quite strong. It was the third largest quarterly fundraising figure ever for unlisted infrastructure fundraising in Q1 2020, but over half of that was made up of one fund, and I think that's just an illustration of perhaps some of the challenges facing smaller managers in attracting LP commitments, particularly in a situation where track records and evidence of previous success will be key determinants to their future plans.
Thank you. And I think that was also a thing in the preparation in our debate, and to share with the group as kind of strategies, LPs going forward, that there is a trend towards more larger names, bigger platforms, and then there are specific LPs with specific mandates and more neon strategies that back a specific fund. And then there's a group we currently have not represented here on the panel, but that I might speak for, is family offices, more the private investors that today have substantial resources that tend to go more into medium-sized managers, smaller managers, as they look for a more direct investment experience. So it's kind of separating from there. Now let's go to the look forward. And in the last webinar we said, going from defense to offense. And looking into the midterm, and we defined here for the purpose of this webinar, the midterm outlook to a kind of 2021, 2022 time period, and to start, and we can again pick up on some of the Preqin data that was shown, and okay, to start with you in the discussion, what is your view on the two vintages 2018, 2019 that have heavily invested in the late part of the cycle and are now faced with the current situation? What do you think will be the effects, and how is Stepstone viewing on these vintages going forward? And maybe also in true perspective, what you would look like at a 2020, 21, 22 vintage going forward. How is kind of your 30,000 foot view on the world on that?
Happy to provide that. I mean, I think it could be a case of sort of history repeating itself. I mean, going back to the global financial crisis, I mean, I think we saw that, private equity funds with 06, 07 vintages struggled, given adverse operational impact to portfolios and more difficult exit environments that led to longer holding periods. I mean, ultimately, I think it was rare for these funds to wrap up within the typical sort of 10-year period. They were often 2-3 year extensions. I think, many of these ended up actually looking okay on a money multiple basis with longer holding periods for assets, but were heavily impacted in terms of IRR. And I think it's likely we'll see something similar for the 17, 18 vintages, quite frankly. I mean, I think clearly with more pronounced effects on the funds that are significantly deployed. I mean, it's likely we'll end up seeing 12, 13-year funds with similar return characteristics, potentially decent money multiples, but weaker IRRs and DPIs driven by slower realizations. At the same time, maybe I can sort of link that to the opportunity, which I think was the second part of your question. At the same time, I think we are entering an environment which should have more attractive pricing, perhaps less availability of leverage, but what should be a great environment for finding value. And I think the 2019 vintages with minimal deployment and 2020 vintages, could be well positioned to capitalize. I mean, I think in terms of the upside, I think history tells us that the most attractive vintages for funds generally have been sort of directly after the end of crises, with better value driven by more favorable environments. I mean, I think depending on how long this crisis will continue, and I think that is a debate for another day. 2020, 2021, 2022 funds could be seen as attractive vintages, especially within certain strategies. I think more sort of complex transformational strategies, for example, could potentially do well. Also, more defensive sector-focused strategies. I think healthcare technology could also, continue to fare well in the sort of future medium-term environment.
Thank you very much. I hope Marco now has a better line. And what's the IFE's view of the world? In the preparation, you were speaking about, or in the intro, that some funds, especially those at the end of the investment period with less dry powder, needed some emergency bridges. And going forward, how is your view, and where is the IFE focusing looking forward, 2021, 22, and where will the money go?
Yes, thank you. I try only with the microphone and no video. Let's see if it's better. I share the view. Vintages may be very interesting indeed. Funds with dry powder to invest may benefit from corrected prices, lower leverage levels, and therefore pose the basis for better performance in the future. I think in the medium term there will be, of course, opportunities in some particular strategies. I share the views that certain sector defensive sector strategies can particularly benefit. I also believe that there will be again a substantial interest for regrowth strategies, kind of turnaround and regrowth strategies. But I especially believe that this crisis will set up the scene for a quantum leap in the amount of money invested into direct lending through private debt players. It has been a steady growth in the European scene for private debt compared to bank lending in the last 5 to 6 years. We have now reached the level where more or less 50% of the corporate loans are going through alternative lenders. I believe that this crisis will create enormous opportunities for private lenders as soon as the enthusiasm created around the various measures, guaranteeing measures provided by various member states to the banks in order to cope with immediate liquidity issues will be over. As soon as these measures will end up, banks will go back to their standard selection criteria if they ever have abandoned them. And on the demand side, companies will be in need of solutions which are not straightforward and not easily analyzed by banks. So this will be the territory of the opportunity for private debt lenders. They will be able to engage with companies which are less straightforward, to price the opportunities accordingly, and to select the most robust of them. So I expect that this will provide great return opportunities with lower volatility compared to pure equity, and therefore will increase the attention of LPs to this type of asset class going forward.
Thank you very much. And I just picked up a question out of the questions section as we were talking about different strategies, and maybe Michael, what would be geographies you would see as winners and losers? And then also, Margareta, please, what type of technology and sectors you see in the VC space? But maybe we go with the geography question first. How is Stepstone viewing the world, and where do you think the money will gravitate to from a geographical perspective?
Yeah, I mean, that's a great question. I should sort of caveat my answer by saying, first of all, that we very much, in terms of geography, I mean, I think it's very difficult to sort of focus on individual geography unless it's within a sort of broader portfolio where you've got exposure to other geographies to sort of, you know, minimize some of the potential geographic risk that you'll face. I think looking at the sort of Preqin data, it seems that there's I think a rebound is sort of a bias towards North America. And I imagine some of that is driven by exchange rate considerations. I mean certainly you know, the euro has struggled a little bit. I think certain currencies, I'm thinking particularly the sort of Norwegian kroner here in Europe, has sort of struggled. So I think we may see you know, I think certain geographies within Europe and even sort of in emerging markets seem less attractive relative to for example, the US, where you've got a USD denominated fund, USD denominated companies, and you don't have to worry about that sort of risk. So I mean, I think you could see a sort of flight to quality, at least in the short term. Of course, the converse sort of argument to that is you could be coming to a European or an African or a Middle Eastern fund at a point where the exchange rate looks attractive. So I think there are different viewpoints you can take on that.
And maybe a question for Margareta on Poland. How do you see first-time funds? Is that theme going forward, or do you think this new created environment will provide opportunity also for first-time funds to be successful with your fund of fund and raise capital with you?
Well, we have actually, I would say 30% of the whole our portfolio is first-time teams. So it's a huge, actually, part. It's 1/3 of the 37 VC funds. Well, I think that they might have challenges in their portfolio companies. Not only encountering liquidity issues, but also sectors which they already invested in. They are now seeking for health tech, of course, and food tech, maybe more logistics, because everybody is talking about food tech. I don't see any food tech industry growing massively in VC. I would rather call it logistic, connected with food delivery. So this and telemedicine, of course, but these two sectors are now, I would say, most attractive from the VC perspective here in Poland. And of course, all the companies who can help digitalize. What we can see is that the digitalization is speeding up, and in the companies with older approach, it has been changed within 2 months. So also this is the opportunity for VC to look for the companies who can fill this gap and who can have direct clients among those who use this kind of tools.
Yeah.
Of course, software enterprise. This is something which is also we see a huge demand for it among VC, IoT, and robotics. All the solutions which can minimize human factor.
Okay, well, I think thank you very much. You caught a lot of questions from the section on the sectors, on specific strategies, and really to have an edge and a specific mandate. So let me just get here to my little cheat sheet. How, Marco, we discussed that. We discussed strategies and other things, but at the end, oh, now he disappeared. I'm saying a question. So okay, you got 2 steps. So how will you assess? What is your strategy and your view for assessing performance the next 24 to 36 months? So because obviously there will be a lot of noise in the numbers, and maybe traditional ratios and KPIs might not work, or might not be applicable, or might be misleading. So how is Stepstone, with such a big portfolio, and also the pensions and the institutions you're working for, how do you plan going forward to deal with an environment where maybe established metrics might not work, or how are you viewing that?
Yeah, absolutely. I mean, it's a great question, a very, very poignant one. I mean, I think, as you sort of mentioned, we have a pretty significant database of funds. I mean, literally in the thousands. So, I mean, we've got a good database of sort of fund performance, but also sort of underlying company operating metrics, which I think is important and will become increasingly important for us. And, we ask our GPs to provide us with this whenever we move into due diligence on funds, and when we try to sort of roll these forward, provided we get the data. And I think it's clear that we'll need to caveat a number of our assessments of managers in terms of valuation in this environment. I mean, from what we've seen, specifically for Q1 valuations, there's been a pretty big disparity between how GPs have approached valuations. I mean, I think there have been various sort of interpretations of the IPEV guidelines for Q1. And certainly for the next few quarters, we'll spend, I would say, more time than usual on testing those interim valuations in terms of public comparables, precedent transactions, to be able to actually benchmark funds fairly. I think certain GPs have been more aggressive than others, and I think we need to sort of take that into account when we assess funds over the next couple of quarters.
Great. That's. I think there will be an ongoing debate. I'm in my capacity as investor relations. I'm kind of also in these dialogues to say, hey, we might be reporting things on a quarterly basis, but you have to have the full picture about what's happening in the specific market, and some parts of the portfolio might develop very different from other parts in the portfolio, and this brings us back to the first point. You have to have much more dialogue and much more interaction and explaining that, and you brought up a point that you build up big databases and data sources to kind of validate this type of data. Let's what we had a couple of questions for the IF, so we have to skip here and maneuver. What do you think will be a dominant theme when you think about best practices? So we thought about what was the immediate effect and what will change: travel, meetings, other things. And what do you think will be when you come for data? Do you think that the reporting standards will change? Will this data analysis and this digging deeper into the data, will that be a thing that will stay? Okay.
I mean, I think it'll depend on. I mean, various LPs will have different capacities to look at data. Various LPs will be privy to different types of information. I mean, I'd like to think the GPs will be as transparent as they can be in these sorts of situations. But I think the broader point, in terms of sort of best practices over the medium term, clearly this crisis and this uncertainty will make it even more important to pick the right managers for the long term. I mean, I think as we saw in the previous crisis, I think we'll see a sort of growing divergence between the very best managers and the more sort of average or mediocre ones in terms of performance. I mean, here at Stepstone, we try to cover pretty much the entire market, and we cover over 1,000 managers in Europe. And I think our job of picking the very best ones, if we do it correctly, I think will lead to an even greater sort of alpha in terms of performance versus the benchmark than what we've achieved historically.
Okay, I'm now looking on the clock, so we are nearing the end, and I now want to go more to the interactive part, and so I'm trying to follow here the questions and the chat. One question, profit margin. What is your view, or let's maybe put it more broadly? what's your view on value creation and returns going forward? So we discussed it, that some of pre-crisis vintages might have longer fund holds, extensions, and the IRRs might go lower, but maybe the money multiple after 10, 11, 12 years might come up to mid private equity expectations. How do you think performance will be now for the upcoming vintages 2021, 22? Would you expect a significant jump in the performance due to better profit margins, or would you say it's back to normal? Will there be outsized returns in this environment?
Yeah, I mean, I think maybe sort of taking a step back. I mean, if you can think of sort of value creation in a sort of private equity setting, you can roughly sort of break it down in terms of sort of overall top line growth, margin expansion, and ultimately multiple expansion at exit. I mean, I think investments made over the last couple of years, I think it's fair to say a lot of GPs, probably most of them, have been factoring in a fall in exit multiple compared to the multiple at which they purchased the asset. And I think a lot of those GPs were really sort of driving off revenue growth and margin expansion. I think increasingly over the next couple of years, you're going to see potentially greater value at entry, and potentially GPs reverting back to maybe a few years ago and factoring in multiple expansion at exit. Obviously, it'll depend on the sector, depend on individual themes, but I would say multiple expansion may become a greater sort of tool for value creation. Having said that, I think EBITDA margin specifically is one of the more sort of, foolproof measures of creating value. It's something that, certainly we value a lot when we analyze GPs. It's something that is, something you can achieve over various cycles. If you're good at transforming a company, it's something that you should be able to do regardless of the sort of the macroeconomic cycle. So it's something that we value in particular. I mean, hopefully that sort of answers the question.
Yeah, thank you. You couldn't answer my daughter's question, so I had to do this. But this is working from home and how things are these days. So sorry for this interruption. But important questions. So let's go back to the chat. Let me go through. So please, everybody in the audience, we still have close to 100 people here. Throw up more questions in the question section, because it's hard to follow in the general chat flow what is a question and what not. And then you have the ability to vote up and vote down questions. Decision-making factors. You talked about, or Akhil from Sepson talked about picking top quartile managers. Margareta spoke about sector expertise to really capture value in a specific thing. Maybe to Justin and Preqin, do you see a greater move in the decision-making process? Is this becoming more data-driven? Is this more in individual and opportunistic approach? Where do you see the decision-making of LPs committing forward in the fundraising process? Where do you think the priorities will be? Will it be what type of data are you collecting, or is this a current area of research? How the decision-making will go forward?
Sure. No, I think there's absolutely increased demand for data on both both on themselves, but also from external sources as well. And I think it's becoming an even more key part of the decision-making process for, again, whether they're small LPs, and even, like you said, family offices and wealth managers, to actually right the way up to your large pension funds, be they public or private. So I would suggest that our experience shows that LPs are very keen on any data, but the accuracy and the depth of that is what's key, and then being able to interpret and utilize.
I'm just writing in the chat section and answering one question. Thank you very much. And yeah, I think that plays well into the point what Akahil just said. More data-driven process. Looking into the questions, what do we have? New chat messages. Let me see. Please also look at the poll section and give your answers to the polls poll question being put up there, so that we can provide some analytics and share with the audience here following that. And okay, so I think we got most of the questions covered. Now let's. I would like you all to pull out your crystal balls and look beyond. And what do you think is the greatest threat? Let's say beyond the 21, 22 years immediately following the crisis. But what do you see is the biggest long-term threat to private equity and private capital? And Margarita, please have a start here. What do you think is the biggest risk you see over the long term?
Well, I think that this is the overall decrease in market performance. Funds being in the middle of this investment period, I think suffered the most in Poland. Decrease of companies' valuation can also incredible drop in funds returns. Keeping that in mind, potential V-shaped rapid economic recovery would probably cause also conventional forms of investing to generate higher relative returns comparing to PE and VC. This is also possible. That in turn, if we look in a 4 or 5 years perspective, can negatively impact also the general overview of the whole industry, causing entire industry reputation to drop. Of course, funds established in 2019, 2020 would recover, but it's going to take significantly, I would say, a longer time. How much it's difficult to adjust and to say.
Okay, how is your view? Where do you see a risk over the long term that we are facing? That you're actually monitoring and watching that you're fearing?
Yeah, it's interesting. I agree with Margaret. I mean, maybe sort of taking a step back. If you'd asked me that question 6 months ago, I would have said clearly it's the dry powder in the market, and ultimately sort of the pressure to deploy for GPs and ultimately the higher pricing that leads to. I think as well, what that leads to is for a number of GPs, lower underwriting targets, and ultimately a dilution of returns for quite a few managers. I mean, clearly private markets, private equity has outperformed public markets for a while now, but I think over time that PME has dropped, I think, in most sort of specific markets. I mean, clearly this crisis will have an impact on dry powder and I think ultimately pricing. But I do think this sort of uncertainty will again make it even more important to pick the right managers for the long term. I do think we'll see a sort of growing divergence between the very best managers and the more mediocre or average managers in terms of performance. I think that sort of, call it upper third quartile, lower second quartile may sort of decline over time. It's really about picking the sort of top quartile managers to make sure your investments or your investment performance stays strong.
And where do you see the biggest chances? So We talked about top quarter. Do you see specific strategies, specific things you Marco said previously, and we discussed in the discussion, and I'm sorry that his internet connection didn't work, so we need more investment in his community in digital infrastructure. So there's probably one immediate identified investment opportunity for some high-speed internet connectivity solutions for the IFE. But joking aside, where do you see strategies going forward? Where do you see, Marco said, asset private capital, private debt. What are stepstones were, and then Margarita after that to you. But okay, where do you see really the sectors and the strategies are that will benefit?
Yeah, it's interesting because I mean, in terms of long-term perspective, I think even after COVID disappears, you know, if it fully disappears, that's. I mean, I think there will be a long-term impact on how we see the attractiveness of certain sectors. I mean, I think travel is clearly one that will be, you know, affected over the long term. Restaurants will likely suffer as well. I think people, and especially millennials, as we sort of move on into the long term, will. I mean, there's a view that generally consumers will become, you know, more risk averse, and whether private equity takes, I guess, as a big proportion of their investment capacity and allocates that towards those sectors, I'd be surprised if they did. In terms of sort of sectors going forward, I mean, I think I would try and sort of focus on the ones driven more by mega trends, whether it's sort of aging populations or you know, digitalization, ESG. I mean, I'm thinking specifically of sort of healthcare, technology, but also consumer staples. I mean, I think there are certain sort of defensive sectors. Food, for example, is one that will always do well. And I think maybe sort of moving away from sectors, but maybe sort of broadly, I think transformational strategies. I think someone might have said earlier, but I think, you know, special situations, you know, loan to own, complexity focused strategies that are viable across the cycle will also be seen as attractive. And I think we'll have a sort of growing focus on that going forward.
Thank you very much. This is a broad area of interesting opportunities. And Margarita, where do you see for the VC more from a VC perspective? Where do you see the opportunity ahead, and where do you see your role as an LP, enabling funds to grow, enabling funds to come to life in your region with your mandate? Where do you think is the biggest opportunity for PFR here and for you and for the funds you invest in?
In terms of investment, as I said, there are certain sectors which are booming now, and we see that returns in those funds, well, due to COVID for some, and because of the COVID, will increase significantly. We have many funds focused on technology-driven companies, and this is the biggest asset. When we see the long-term opportunities for us, is we see there will be natural selection of top managers, even in Poland in this young industry. I think that those who can handle crisis management and certain type of restructurization by not only cost cutting but helping in cash flow management and also restructuring business models, pivoting business models. This is these managers will be the, I would say, opportunity for us in the future, and they have chances to have high returns. So this is how we see the VC market in Poland.
Great. So Marco, good to have you back here. So I'm not sure what you could follow, but basically we were wrapping up and saying where is the great opportunity over the long term, looking beyond 21. and we talked about specifically strategies, sectors, Margareta's view on the Polish market, and where it's able, and from the IF's view, how do you see yourself 2, 3, 4 years into the future, and what will be what will have changed in the IF's behavior, and where do you think what opportunities you will gravitate towards?
Yeah, thank you. Yeah, I've been able to follow almost everything. I'm very sorry that my outbound stream apparently was not working well. So I very much agree with the analysis about sectors and market segments. I would say, as far as EIF is concerned, the idea is for us to be mobilizing a lot of efforts in not only in the traditional products, in the traditional segments of the market, but also on slightly innovative type of products that may help the market fill the gaps that will be created by the crisis. For example, we have launched a couple of programs now exploring the use of different classes of shares into the funds with a certain degree of limited returns compared to the other LPs, in order to be able to attract the interest of LPs on strategies which otherwise would be less attractive. For example, we applied this on scale-ups recently. Depending on the outcome and the market appreciation of this pilot, we may extend it to other type of strategies. We are trying to put a lot of attention to regrowth strategies along various different dimensions. I imagine that in general there will be a lot of attention more on certain strategic sectors for Europe. There have been quite some debate about the fact that during this crisis Europe has faced the shortcomings of globalization, with certain strategic sectors which have not been defended enough, and with supply chains which have been broken and which have caused a lot of impact to European champions. So I suppose that there will be a lot of attention to defend European champions, to rebuild supply chain more locally, and to ensure independency of Europe on the strategic sectors. So this is an area where we will be working a lot. At EIF, we are trying to build in parallel to attention to products, we are trying to build vertical type of focus in terms of sectors and initiatives. And this type of strategic sectors will certainly find a lot of attention. I would also conclude by saying that one big opportunity for the relaunch of economy in Europe is climate action. It has been a bit put aside during the last 3-4 months because, of course, attention to COVID has kind of shifted the paradigm from the big investments towards climate action that were starting before. But we believe that when it will come to regrowing a different type of more resilient economic tissue in Europe, across Europe, investments towards greener technologies and greener businesses will represent a great opportunity.
Thank you very much, and I can only thank here my panelists for the preparation, for all the work and effort that went into this webinar. Thank you for the audience, and thank you for 100 people staying on and following us until now, which is a great outcome. And obviously this will be recorded and will be available for replay, and materials will be shared for registrants posts with an email following this webinar. Let me quickly summarize, and I think a key takeaway is strategies for LPs going forward is that there will be a clear differentiation. There will be LPs with a clear, let's say, regional or political mandate, like the IIF, PFR, which will do whatever they can do to support their mandates to cater towards a growing to grow a local ecosystem of VC, to transform a region, to transform Europe as a whole, to fill in the gaps where private capital might not be sufficient. And Stepstone on the private capital side, saying, hey, really the manager selection, to really find those managers able to manage the complexity, to adapt to changing environments. That is really a key focus, as what Akayla just explained. Staying with the right managers, supporting them is really a key thing here, building the relationship, and then finding those good managers and bringing more capital behind them. And that is obviously an exercise where a lot of data needs to be crunched, and there we have the Preqins here, and as Justin showed, following the trends, having the data available, and making those benchmarkings possible is then a key thing to identifying those GPs that really are able to create that value, and providing a good basis for the decision-making process. So thank you, everyone, and thank you for the organizers at O100 conferences. And as I did in the chat section, a couple of questions also for fundraising on the first-time fund and some of the fundraising environments. There was a very good podcast also on the podcast series about fundraising, which I found very insightful. So please also go into the podcast section and check it out. Thank you very much, everyone. We're coming to our time limit here, and please feel free to reach out via LinkedIn, via the emails, via the contact information shared previously to all the panelists. And thank you. And Joseph, back to you.
Okay, thank you, Robert. I mean, I think your daughter is, she's saying hi to us as well.
We're scratching the time limits. My brutal here. So
yeah, I saw you probably have an appointment at 6:30 with her. Yeah, so thank you very much, Robert. Thanks to all the panelists and all the attendees contributing with their valuable insights and the questions from the audience. We hope you certainly enjoyed it. We would very much like to see you again in a couple of weeks at our VC webinar. As mentioned, you will get the Preqin data and also the replay of today's discussion in the email following after the end of the webinar. So thank you once again. Stay safe and hope to see you next time. Goodbye.
Thank you very much.
Thank you. Thank you very much. Bye.